First off, I want to go over kind of what's happening with the markets right now. So I'm going to go ahead and share my screen. And I'm going to go to screen 3, share. All right. So it's a manic Monday. Since mid last week, we've had a little bit, if you can see my candlestick charts here, we've had a little bit of a run negative in bonds, which is bad for interest rates. So if you could see this number up here in the top left, we're at negative 27 for the day. That's not a good start to the week. It's a pretty bad trend, especially because this week the Feds are going to be talking, and usually the markets adjust a little bit towards what they expect to happen when the Feds speak. Now, the biggest hot topic we have in regards to rates right now is inflation. So here's the inflation that we had last month. We're at 5% so far for 2021. That's the highest inflation we've had in the last 20 plus years. So this is not a good thing. We all see it, whether it's rents going up, gas going up, wood prices going up, milk going, whatever it is, everything seems to be going up. Some of it you scratch your head and will say, well, why is this happening? That's another discussion. It needs to be fixed, but we can have that a discussion at a different time. But it's somewhat inevitable right now as far as what's happening with inflation. So we have to deal with it. And again, inflation is the enemy of interest rates. So when we see inflation that's higher than 3%, remember the GDP, the gross national product, or the estimate, the average wants to be around 3%. So inflation plus our growth needs to be around 3%. That's the ideal to keep everything similar and same. Once you have inflation higher than 3%, then bonds are worth less. So you get a bond at 1.5 and inflation's at 5%, your money's going to be worth less over time and nobody's going to want it. So interest rates have to increase to keep up with it. That's kind of how inflation numbers work. So interest rates should rise. So that's why you're seeing this right here. Now, the only way to offset inflation is to raise interest rates. Well, the last thing the Fed wants to do right now is to raise interest rates in an environment where housing is hot and prices are going up. We don't want the cost of mortgages to go up as well, because then we'll have a pretty big revert or opposite effect where we get a huge slowdown. So the Feds have they're in a unique position. They've kind of played all their cards, and now they have to play with what they have dealt now. So we're going to see some interesting economic swings, I think, in the next couple months, but we'll see what the Feds do. But right now, we're at negative 27 basis points. If you look at that from a mortgage standpoint, here's the Mortgage News Daily, guys. This is a great website. It gives you an average of what the mortgage rates are. If you can see here, everything's in red. That's a bad thing. That's a bad sign. So that means rates that posted on Friday are worse than where they are this morning. And then the below is what's actually happening in bonds, which is worse than they posted in the business day Friday. So we're in a negative trend. So I locked all of my loans last week. I'll show you where I locked. I locked right here. So if you can see this little blip right here, this little high, this candlestick that reached its pinnacle, I locked about 7 or 8 loans right there. So I saved our customers from 103.9 to 103.3. So about 60 basis points in cost. So essentially a rate that was at 3% with no points. Today that cost 0.6 discount points to get the same rate. And if I would have been waiting, or if I was on vacation, if I didn't lock that, then my customers would have had a higher rate, or 0.60 discount points now associated with that same rate. So knowing when to lock is extremely important. So that's a little bit about how interest rates are going. I'll keep you guys abreast of what's happening. Here's the economic calendar. This is what I watch every day. So producer price index, that's another inflation numbers coming out. Retail sales are coming out. New York Empire Manufacturing Index. All of this has big impact on interest rates. And then here, 11 o'clock on Wednesday is the Fed interest rate decision on what they're going to be doing. This can be scary. They may say something that spooks the markets. So this could be a pretty interesting week as to what happens with interest rates. And then Thursday, we've got the initial jobless claims. So we'll see what happens there. Now, our topic of the day is credit. This is probably the most frustrating part to consumers in this market is credit, because everyone now is very aware of their credit. Very, very hyper aware. Everyone has these little tools on their apps, on their phones that allow them to, I'm gonna unshare this, hold on, allow them to see their credit scores at any time. And those credit scores are actually different than, different than an actual mortgage credit score. So if any one of your customers have an app on their phone, that's most likely what's called the Vantage credit score. It is a different type of a scoring model, and it is more lenient on negative items on credit. So every time you look at your app on Discover or Visa or your bank or whatever it is giving you false hope. Now, it'll give you an idea of what's happening with your credit scores, but it will not give you an accurate mortgage credit score quote. So that's, I think, one of the biggest frustrating parts for consumers is they say, my credit score is a 740, and then we run it and it's 690. And then they freak out. They think that the mortgage credit pull actually had a negative impact on their score, and now they're mad at me. So anytime I run somebody's credit, I try to alert them as to, okay, when we run your score, what do you think it's at? Because typically it's coming in a little lower. But running a credit score for a mortgage check, and this is important to take notes on, it only affects you up to 5 points. So running a mortgage credit only affects you about 5 points. It's minimal. And it affects all three scores about 5 points. So it doesn't make a massive impact on the actual credit score itself. So anytime somebody says, I don't want you to run my credit because I don't want the credit scores to be impacted, it's only about 5 points. The biggest impact they see is because of the scores they're looking at. So I want to go over what is a credit score. First off, a credit score is nothing more, and this is my definition, but it's a good definition. It's nothing more than a report card on how well you manage open lines of credit. I'm going to repeat that. It's a report card on how well you manage open lines of credit. If you don't have any open lines of credit, you're going to get an F because you didn't do any work. You turn on a blank assignment. You're going to get an F. If you have a lot of credit, but you're not managing it well because everything's maxed out, you will get an F. So if you look at it that way as a report card, you can easily see how a credit score can vary depending on your different circumstances. Now, some good rule of thumbs are you want to try to keep all of your credit balances below 30% of what you can borrow. So if you have a credit card, you could borrow 10,000, you want to keep it at 3,000 or lower. Now, you might not know this, but my family, and I'll use me an example, I have a credit card through Costco, and I get 2 to 3% back in cash every year. So guess what I do? I put my car payment, I put my everything I do on the one credit card. So every month I have a zero balance to a, well, hopefully not too expensive of a balance, depending on how much we're spending that month, but I pay it off every month. But if I was to run my credit report a week after I paid it off, compared to a week or the week I have it maxed out, my credit score will vary by about 45 to 60 points, just because I have one credit card maxed out. So just because you pay it off every month has no bearing on what your credit score will be at the time you pull the report. So yes, you have a good pattern that will show over a long history with no late payments, but it doesn't matter. It's what is posting at the time it's pulled. So keep that in mind. If you do have those credit scores that you rack up and you're maxed out on them, it's about 45 to 60 points for a maxed out credit card of negative. So that's a big difference. I mean, that's a difference between a 3.125 rate and a 3.5 rate. So it makes a massive impact to your credit score or to your interest rate. Now, you might not know this as well, but if you have one mortgage late, just one mortgage late has up to a 120-point impact on your credit score. So you could be clean as a whistle your whole life, and the month you try to buy a home, you accidentally went late on a credit card or a car payment, and now you went from a 740 to a 620. It happens. It happens more than you might expect. It's a big impact. So staying current on your credit cards is the most important piece. Now, collections are one of those things that are sometimes inevitable because things happen. I had a $5 collection from a hospital copay in California when I was injured in an accident that I didn't pay, and they don't cross state lines, so they can't tell you about collections across state lines. So it went to my credit, and that kind of stuff does happen. Now, paying off a credit item, such as a collection, paying it off actually hurts your credit score. Doesn't make sense, but this is why. Any type of activity on a negative credit item has a negative impact on your score for that immediate moment. So if somebody comes to you and says, I have a bunch of collections, but I'm paying them off, tell them, no, don't touch your credit. It will have a negative impact on the score for the immediate 2 to 3 months. Now, other things like charge-offs, large items that like repossessions, those have a pretty big impact and they stay around for a while, but typically it's because you've had late payments for a long period of time. So having them hop on your credit as a charge-off really doesn't make an impact because you've already had those late payments for such a significant amount of time. So keeping your stuff current, not going to collections, is very important to your credit score. If you settle debt, if you have a credit card for $15,000 that you can't pay off and you say, you know, I'm going to settle for $6,000 and you pay it off, they will show settled less than owed, and it will have a 50-point impact on your credit report. So even though you paid it off, it'll be settled and it'll be on there as a settlement for the next 7 years. Now, if you have a cell phone that you have a collection on and they don't report for the most part, but now you have a collection, so now it's reporting, that's up to 110 points or 120 points, just boom, right there to your credit score. So those types of collections that are from utilities can have a massive impact as well. So that's a little bit about how collections work. Again, paying them off, do not do it because it could have a negative impact. So credit scores are very, I mean, they're a pain in the rear end to manage. Now, I have a program and it's actually being really ramped up. I own FICOBoost.com. So if you go to FICOBoost.com, it takes you to a website where it's free credit updating and monitoring for people that are looking to buy a house. It's not a credit repair, but it is a credit analysis and a plan to get back on track. So eventually there will be a credit repair aspect to it. But for now, it's there to help you guys. If you have buyers that have interesting credit, I'll give them a path to help their credit. And there's a lot we can do. Just adding their rental as part of a line item on their credit will boost them 40 points just for doing that if their rentals are on time, obviously. But if there's something on the credit report that actually happened, like a foreclosure or a bankruptcy, or they were late and they can't get around it, there's no way of taking that off. And those credit report companies that say they can do it, what they're banking on and what they're promising you is that if they send these letters to the institutions, that these institutions will forget to respond. And if they forget to respond by law, they have to remove it from credit. That's the only thing they're banking on. They're banking on a mistake from the internal credit reporting parts of these major lending institutions. I wouldn't bank on that if you're trying to get your credit scores up. And you can get a credit score removed from your credit, a foreclosure or something removed maybe from your credit, but it's still public record. So there's no way around that from public record. So any of those credit report companies that claim they can do that, it's really a misnomer, or it's a lot of false hope, because guess what? They get paid $100 to $200 a month for up to 12 months to try to boost your credit scores. So the credit repair industry, I think there's some good people in it, but there's a lot of scams. So just be very, very careful with that. Now I'm going to open this up to a lot of credit questions. You probably have a lot. You have a chart for how things impact credit. I can put one together. I don't have one. I actually tried to look one up, and every credit company out there is very secretive. I guess they want you to call them. They don't want to give out the information in those types of graphs, but I could try to put something together for you on that. Some things that we do while I open up the chat, feel free to ask questions. Even unmute yourself and ask if you want. But one of the things I do when I meet with a customer on a pre-approval is, let's just say they had a, well, let's use one I had today. I have a customer that had a 758 credit score in January. They went under contract in May. Their credit score expires, so we had to get a new credit report. Their credit report dropped by 40 points because they had one of their credit lines maxed out. So now we're in the midst of the process. I'm doing that credit rescore for them. It does cost about $300 per trade line, but we absorb the cost. So no lender can charge that. A lot of good lenders offer it, but we just absorb that cost to try to get the better terms for that customer. So they were a little disappointed. Their terms would have been a lot worse by about 3/8 in rate. It makes a huge impact. Your credit score has a massive impact on mortgage insurance and on your actual rate. So we're getting that back to where it was originally, and then we're going to close with the same terms that she was initially expecting. So doing a rescore internally, if we can catch it ahead of time, can help people get terms that are better. If you have somebody that was declined from a Bank of America because they're trying to get a jumbo loan and their credit score was a 710 and they require 720, we can help them boost their credit score, get that higher credit report, and then move forward. Banks will not do that. They will not do that. Different mortgage bankers like us, they do have the ability to, not all of them do, because it does take money and extra effort, but it is something that we offer. So make sure if you do have a mortgage partner that's not me, first off, we need a one-on-one meeting. But if you do have one, then absolutely ask them if they can do that for you if they have customers, and what their policy is to try to do that, regardless if it's needed or not, to get the loan approved. All right, so I'm trying to keep this short. Any questions? Does using Amex help affect credit score? It depends. American Express is just like any other credit report, credit item, and how it reports. It's always based on what the actual balance is. Some American Express is you have to pay it off in full every month. So if it's reporting a low balance, you're fine. If it's reporting a really high balance, it will have an impact just as a normal one would. Now in qualifying, we just need to show that you have enough money in the bank to pay it off, and then we don't have to hit you with the payment. Provide us with a what makes you different. We can share with our clients. Okay, I'd be happy to do that. It'd be a very, very long list. I'm just kidding. If you've known me long enough, you know I'm not normal in many aspects. I like to have a good time with everything. But any other questions? Don't be shy. I mean, credit is the #1 influencing factor on whether your buyers can buy a house or not. And we take a pretty large, aggressive approach at making sure our customers are there. So I'm going to show you what it looks like if you go to FICO Boost. It's nothing special right now. So if you go to FICOBoost.com, I'm going to share my screen. Share screen number 3. It's just on my website, and it's just a sign-up sheet that people can go to sign up to go ahead and take part of the project. It is a project because it takes a lot of work to make sure that they are set up. But don't fill this out. Just call me. Have them call me direct, because a lot of times these go to my spam. I'm in process of revamping this, so it's going to be its own separate website. But there's a lot of rules and regulations on that, so I have to follow. But FICOBoost.com, and eventually it'll be a free tool for somebody just to have an app to go on and boost all 3 of their bureaus. But that's in process. So until then, I will be your source for any questions that you may have. And let me stop share this. All right, what's the lowest credit score someone can have and get a mortgage? Good question. So the lowest credit score for conventional is a hard stop for every lender in the country. The lowest is 620. That's the absolute lowest. Now, somebody at 640 may not still qualify because of their overall risk associated with the file, but the barrier of entry 620 is the absolute lowest. Now, this might shock you. FHA and VA do not have any credit score requirements. They don't. The people making the requirements are the lending institution that you're going to for the loan. Now, it doesn't mean that if you have a 490 credit score, you're automatically qualified. It's all based on risk. Here's an example. If you have a 560 credit score because you had a, well, I'll use an example. Terrible divorce in your past, lots of stuff went to hell in a handbasket, but now you're salaried, you make really good income, everything's current, and you've got 5 to 10% down, plus you have some money in the bank, but you have a terrible credit score. FHA could approve that loan. Now let's take another example, 620 credit score, but you're right in the middle of the storm and you don't have very much credit or don't have very much money. You have just enough to squeak by, but no reserves. That 560 credit score would get the approval where the 620, you may not get an approval. So it's credit score is not a factor for FHA and VA. It's an overall risk, but lenders will set a barrier of entry at what they want because every lender is scored. They have an FHA and a VA scorecard on how well their loans perform. If they're doing a lot of loans below 620, their pricing on their loans will be less. They won't get as good of rates. What Pavan, the owner of our company, has realized is that those people with the really low credit scores that are back on track are thankful for getting a mortgage, and they're actually better performing loans than the ones between 600 and 640. It's kind of an interesting phenomenon. So he's under the impression that he will never have any credit score requirements. If the person's risk is low, regardless of their credit, he wants to make sure they can get a loan. So now not everyone fits the mold of being back on their feet. A lot of people are in the process, but they still might have some work to go. But helping their credit scores and helping them get that up does have an overall impact. So a credit score does make an impact on the system's overwhelming or overall review of the borrower because it is a piece of the puzzle, but it's not the only puzzle. So do mortgage.
In that situation, like if somebody was in that very situation you kind of described, but they were still like in litigation with it, is it in their, to get the best rate and everything, in their best interest to wait until like the dust is settled with the litigation, or can they still try while they're still in the mix of it?
You could still try if you're in the midst of it. It depends on, I guess, on the type of litigation. If there's different credit items that are being disputed. Oh, I didn't talk about disputes. If you're being disputed on the credit report, no. I would wait until the disputes are resolved, because when we remove a dispute from a credit report, it adds it back into the scoring model. If there's disputes on a credit report, they're actually ghosted. So that item does not affect the credit score. So if we run a credit score on somebody, this might have happened to you guys, and there's disputes on it, and the loan officer says, yay, you're good, you're at 640 credit score, everything's great, you're pre-approved. And then they realize, uh-oh, it's pre-approved because there's 2 items that are negative that have lates on them that are in dispute. And guess what? You have to remove all disputes when getting a mortgage if they're above $1,000 limit. So if you remove those and now they get added back in, you could have a credit score drop to like 520. So if you're in the middle of something that it doesn't affect your credit score, it's just it's non-sequential to the actual getting of the mortgage, the approval of the mortgage. If you can get the mortgage, get it. You can always refinance later to get a lower rate, but you can't repurchase a loan in a home in the future at a lower price. So that's my advice.
Thank you. That's exactly it. She's in the middle of anyway. Yes, thank you.
Yeah, I would say go for it, clean it up. We'll do a rescore. We'll get a new credit report. We'll get a refinance underway, and we'll get them a better rate at that point. That's what I call a Band-Aid loan. It's a short-term loan. And a lot of times, guys, we can do those short-term loans. If we know it's going to be a 6-month loan, I'll do the loan at a little higher rate, but I'll give them a lender credit of like $7,000 to pay for every single piece of all of their fees. That's why when they come back and refinance, they're not paying for 2 mortgages. They're really just paying for the refinance, and everything else was free on the previous one. Their payment may be $50 higher for 6 months, but 50 times 6, that's what, $3,000? No, that's less than that. That's $300, right? But they save 7,000. So that's how mortgage strategy. That's why I think mortgage lenders, for the most part, will always be needed, because a computer can never do stuff like that. It can never advise, it can never give them best counsel for what to do. But all right, so do mortgage and other loan forbearances affect credit score and future purchase ability? So yes and no. So mortgage forbearances are not reported as a mortgage late. Now I want to show you something real fast, or I'll just read it to you actually. The mortgage forbearances are at an all-time low from when they started at their peak. They're down 2.9% this month. So forbearances are down 2.9%, which is, it's not a huge impact, but it is an impact. So that's good news for that. But they don't report as a late payment. What they do impact is the mortgage loan approval. If you are currently in the middle of a forbearance, refinance is basically impossible. You have to reset that up, do the renegotiation, a loan modification, so to speak, or come clean to refinance that specific loan. If you are selling a home that is in forbearance, you can get a loan without a problem. Let me repeat that. If you're selling a home that's in forbearance, you can get a new mortgage without any problems, because it's not reporting as a mortgage late. All we care about is that debt's going to be satisfied and paid in full. And because it doesn't impact your credit score, it won't impact the new loan. And that's because they have, on purpose, not coded a forbearance in as a mortgage late. It shows as forbearance, but it affects you the same as like a student loan in forbearance. It doesn't impact you negatively. So good question. Any other questions? I answered all of your questions. That's incredible. All right, well, I'm going to stay on for a couple more minutes. And if you guys have any questions in regards to what mortgage rates are doing, any borrower questions, feel free to hang on. I will be here for the next 10, 15 minutes. Thanks again for coming on a Monday morning. We do appreciate your time. And thanks again to our partners, Pioneer Title. We do appreciate you guys being part of this. And if you guys need anything from our team, I'm always here to help. My forehead's so shiny today. I just saw myself for the first time.
Hey, Sean, quick question.
Yes.
This is Savisa. How are you doing?
I'm really good. How are you today?
I'm doing well. Thank you. Thank you so much. That was very informative. I really appreciate it. I had
Yeah,
one quick question. Thank you. One question: when people are applying for rentals, is the credit, like the Karma credit score through the app?
Yeah,
Do you know
Karma,
anything about that?
Yeah, it just depends on how the landlord pulls the credit. if they just use a normal everyday retail credit report, it'll be a different algorithm than it would a mortgage credit pull. So I guess it depends on what institution is actually pulling the credit report. Credit Karma is a Vantage credit score. It's not a true FICO score with a mortgage algorithm built in. So usually when you pull for rentals, the credit scores will come in a little bit higher than if you were to buy and actually get a mortgage credit report.
Okay. Okay, no, that makes sense. Yeah, most of these people are realtor homeowners
Got
with
it.
no access to lending institution programs that they may have. So that makes sense.
And as
All right.
realtors, there's websites you can go to, like Advantage Plus Credit is a company that's close, that's here local. They actually have a portal where realtors can sign up and have your own account to be able to run credit reports for renters and for tenants, and run them right through their system. And it's a pretty slick little system.
Oh, that's great. That's good to know. I didn't know that.
Yeah.
Fantastic.
Yeah, Advantage Plus Credit is the name of the company.
Okay. Thank you so much. I really appreciate it.
Yeah, you're very welcome.
Happy
Oh,
Monday.
You know, the one thing I
Yes.
didn't mention is that once
Yeah.
once somebody pulls a credit report for a mortgage, they have a 2-week window to run it as many times as possible. Totally forgot to say that.
And it doesn't affect more than 5 points
It doesn't
during
affect
that
it at
window.
all. It doesn't affect it at all. Only one credit report pulled by a mortgage company in a 2-week window will impact the credit score. All of the rest will follow in the window of opportunity that the government set up to be able to shop without any impact to credit.
I see. And the credit will change based on if they make payments and stuff like that, right?
Exactly. So if somebody runs it and then a week later pays off a credit report, pays off a credit card, then I run it again. It'll have no impact on the credit, but it may score higher because they paid that item off, or it's now reporting.
Okay, that makes sense. Awesome. That's great to know too.
Yeah.
2-week window. That's
Exactly.
helpful. That's
Yeah.
very
So if somebody
helpful.
says, I don't want to shop around because I don't want my credit to be hurt, let them know they have a 2-week window to run it as many times as they want without it impacting their credit.
And it doesn't matter who the lender is.
Correct. It could be any lender. It could be 150 different lenders. As long as it's a mortgage credit pull, it'll only impact it once in that 2-week window.
Okay, that's fantastic. Yeah, I didn't know that. That's great to know because that's the hesitation about shopping around because they're
Yeah.
worried that it's going to hurt their credit report.
Exactly. Exactly. So if you have somebody that's approved through a bank and you're like, oh gosh, but like, I don't want to run my credit because I don't want my credit to go down. Within 2 weeks, they're safe.
Awesome. That's fantastic.
Yeah, absolutely.
All right. Thank you very much again. Have a great week.
You got it, Visa. Have a wonderful one. Have a wonderful week.
Thank you. You too.
Yeah.
Stay cool.
Yeah, it's a little warm. Thank you
Yeah,
for
our
that.
AC broke, so we're dealing with that. But yeah,
What-
thank
your
you.
AC oh
Have
my
a great
gosh.
week. I know. Perfect timing. It's awesome.
Yeah, and you know what? Right now, the air conditioning companies are behind.
Yeah,
So
we're
hopefully
hoping they have
Yeah,
their parts in stock.
Yeah, hopefully somebody will be able to get that fixed right away.
Yeah, well, they got here, but they didn't know whether they had their part in stock. So we'll see.
Got it. Yeah, that's frustrating. We're waiting on a part 2 on our air conditioning. Luckily, it's still chugging along. It just sounds like a freight train.
Oh, and this is just the worst week ever. So,
It's a little warm. Yeah.
well, thank you, Sean. Good
My
luck with
pleasure.
everything, and thank you.
You got it.
Have a
Have a
good
great
day.
day. All right, guys. Have an awesome day.